Good evening, everyone. Welcome to this, the last in our series of spring talks. My name is Gillian Norton. I'm the CEO of Supporting Wounded Veterans. Helping to get wounded, injured or sick veterans back their independence and putting them into work, training or occupation is a challenging thing to do. But SWV has got a 90% success rate at doing this, all enabled by your generous help and support, for which I would like to say a very heartfelt thank you. Now, as well as all our current programmes, we're working with King's College and we're generously supported by the NHS as we look to see if we can help those for whom years of treatment have had little or no impact on their symptoms. Shell shock, as it used to be called in World War I, or PTSD as we call it now, remains a mystery, and its efficacious treatment remains a mystery. Current treatments have got about a 30% success rate, and the world has now run out of new treatments for mental health. The trials that we're fundraising for at King's College look to see if a new treatment, which looks very promising in the US, really might move the dial round on this most challenging of illnesses. And I would like to be just clear on one thing, which is that if we don't get the trials started in the United Kingdom, anybody who needs this kind of help with trauma-related illness will not receive the treatment for several years. So you've all been enormously generous to SWV. And I would ask you please to go on being generous so that the United Kingdom is not in the position where the whole of the rest of the world was able to access treatment, not only for its veterans, but also for the civilian population, and the United Kingdom was not able to do that. And now to tonight's talk. We're joined tonight by speakers who were at the top of their field. Charles Berry, who has over 45 years experience in credit and political risk insurance, having founded BPL Global with Anthony Palmer and Robert Lyle in 1983. He's an acknowledged expert on the risks of trading and investing in international markets. As chairman, Charles pioneered the use of credit insurance for banks, as well as being an early advocate of first broader political violence cover post 9/11, and more recently, a proper market for war risks on land. Michael Dobson is our other speaker, and he's held many positions. He was chief executive of Morgan Grenfell, and then following Deutsche Bank's acquisition of Morgan Grenfell in 1990, he joined the board of managing director of Deutsche Bank in 1996. In 1998, he took responsibility for Deutsche Bank's global asset management business. He left Deutsche Bank in 2000 and was the founder and chairman of Beaumont Capital Management, which was a hedge fund and high net worth asset management business. It was then acquired by Schroders in November 2001. He became chief executive of Schroders in 2001 to 2016, and he was appointed chairman in 2016. Mark Lobel is going to be our chairman for the talks tonight. He's a BBC presenter and reporter, and he covers business, politics, and foreign affairs. Mark, I'm going to give the talk over to you, and I'm sure we're all going to have a really fascinating evening tonight. Thank you, Mark.
Julie, thank you. It's a real pleasure to be here, not least because I have the utmost respect for you and the charity, particularly hearing firsthand of your trips in Cloisters, the life-changing skiing trips that you have for veterans there, because my mother comes out and helps you, and she tells me I get firsthand stories of your ongoing mentoring role and your help with the future employment for veterans and giving them a new lease of life. So it's really fantastic to be here. I'm honoured to chair this fourth talk in the series, the last talk in the series. They say you save the best for last. Well, our guests certainly will match that. I'm going to be keeping the conversation going tonight. So first of all, it's nice to meet you all. Thank you for inviting me into your drawing rooms and kitchens. As Gilly said, I'm a BBC presenter and reporter at home and abroad. I've travelled with NATO and British forces in Afghanistan. I've covered business news in the Middle East and here in the UK. Now, turning to our two outstanding city titans, between them, they oversee thousands of staff and manage over £500 billion worth of assets. And they've settled insurance claims worth £2 billion or more. So not a bad lineup. And tonight, of course, we're discussing the city after Brexit, which essentially means the future of the city. So, because of course, Brexit has happened, although of course, it hasn't officially happened because it's been penciled in, but the Mont Blancs haven't actually come out yet. And we won't mention Northern Ireland because that's another story. But anyway, the point is that if we assume Brexit has happened, we have a very wide berth tonight. So we can really get into some fascinating topics, not just about the present, but about the future for the city. Please keep your questions coming in. We've received some already, but you can use the chat function here. You can type out your questions and just send them, and then I will ask them if we have time. So send as many questions as you like. But before we start to address the first topic, the elephant in the negotiating room, namely the bit the government left out of the EU trade deal, that's services to you and me, having put all our goods in one basket, so to speak, let's hear from the two esteemed guests about who they are and what they do. And let's start with Charles Berry, the chairman of BPL Global.
Well, thank you, Mark, and thank you, Gilly, for organising this evening. And let me just emphasise, we're enthusiastic supporters of the charity. We think it does great work, and delighted to be sort of asked to participate this evening. My business, I'm not going to talk about very much. It's a very specialised niche broker in the London insurance market. And this is more generally about the city. And I just thought it's worth saying, you know, obviously the city is tremendously important to the UK economy. The total is about 7.5% of the UK's GDP. It generates about 10% of the UK's taxes, financial services do generally. And is a major employer, not only in London, but elsewhere. Turning to my sector of it, because I'm going to leave it very much to Michael to speak from his side, but from the London insurance market's point of view, I mean, it's still quite a big market. We deal with 5% of the global premiums in the non-life market. That's about 110 billion of premiums which we handle in London every year. Our contribution to the UK's GDP is about 30 billion, or about 1.7% of the UK's GDP. We employ about 47,000 people. To give you a flavour, though, of what we do, the London insurance market is very much part of the global marketplace for large and complex risks. So this is not about motor insurance or household insurance and that type of thing. It's very much marine, where London has a 33% share. A large and complex risk, if you've been following the news about what's going on in the Suez Canal at the moment. Energy, we have about a 50% market share. Aviation, the same. And then there are lots of specialist areas like my area, war risk, political risk, areas of credit risk. cyber, which has become a big new marketplace for the insurance market, and so on. It's also a very international market. I mentioned the 47,000 employees, but they're not the important people in the market. Our market is a meeting place for clients on the one hand and capital providers on the other. And when you look at it from that point of view, 2/3 of our clients are international. Half of that international body actually is the States and North America, and the rest is the rest of the world. But 85% of our capital comes from overseas. It comes from America, it comes from Bermuda, it comes from Europe, it comes from Japan, which is a major new development in our market. And the players in the market tend to be big multinational insurers, and most of the brokers in the market are employed by the big brokers. There are lots of small brokers like us, and but we too are an international business. We have offices in New York, Singapore, Paris, and so on, even though we're a very small player individually. And possibly just to sort of give you a bit of a flavor of the sort of thing which goes on in London. Just taking one example, simply because it crossed my desk today, but we're about to launch a terrorism program in Canada. It's why? Because basically there are opportunities in Canada which are not being met by the local market, that the London market is willing to underwrite. There's a big specialty market for terrorism and political violence in London. We're going to place that business in London with the UK subsidiary of a Japanese insurer, and Canadian clients, Japanese capital, but London expertise. That's very sort of typical. But the other thing I'd say is it touches on the whole Brexit question and goes to the heart of it, is we are a heavily regulated market. That's understandable for prudential reasons. We've got to make sure the insurers are able to pay their claims, for conduct reasons, and in the global market we operate in, it's also for protectionist reasons, in that all countries, developed and undeveloped, protect their local domestic industries. And to use my terrorism in Canada example, people don't want to write that cover in Canada, and though we do, we can't issue a policy in Canada. It has to be issued by a Canadian company. How do we do that? Well, the Japanese global underwriter has its own operations there. They will issue the policy. It'll be handled by our local partner broker there. We will then, as a UK regulated broker, handle it in London with a UK regulated insurer, and so it goes on. Everywhere we deal, we've had to deal with that type of regulation. The exception has been Europe, where we have benefited from this marvelous thing that we've enjoyed for decades called passporting, which meant that as a UK regulated business, and it's the same with the insurers and the brokers, they were passported into Europe and could deal with the other 27 countries without further regulatory requirement. And that is what we lost with Brexit. And the question for this evening is, so what? How's it going to affect us going forward? And I think on that note, it might be best to hand back to you, Mark, and to get Michael's perspective on where we are.
Brilliant, Charles. Thank you. Michael, do you want to pick up there?
Sure. Thanks, Mark. Well, look, very briefly, Schroders is a global asset manager and wealth manager. We manage 575 billion pounds. It's a very global business. About 15% of our assets under management come from the EU. We have a 100 billion euro Luxembourg fund range, which we sell around the world. We employ 5,100 people, of whom 800 are based in Europe. So we're very plugged into Europe, and as well as obviously our businesses in the UK and Asia and in the States and Latin America. On the city, Charles made a few points. I mean, I'd add that 2.3 million people in the UK are employed in financial services and financial services related businesses. So it's a very big source of employment, and 2/3 of those people are employed outside of London. So when we talk about the city, I mean, people sort of mix up the city and financial services, or they talk about it as if it's the same thing. But remember that 2/3 of the people employed in financial services are actually outside of London. So it's very much a nationwide activity. It generates a trade surplus of 84 billion pounds. So it's by far the biggest net exporting sector in the country. It accounts for 11% of foreign direct investment into the UK. And as Charles said, it accounts for about 76 billion of tax revenues, which is something like 11% of the total. So it's a very big and critically important industry. If you look at the city's global ranking, I was looking at a ranking that came out the other day. New York was #1, the city was #2. This was actually something that came out of a Chinese consultant, so it perhaps won't surprise you that Shanghai was rated 3, Hong Kong 4, Singapore 5, then Beijing, Tokyo, Shenzhen, and the first European city you get to is Frankfurt, ranking 9th. So in this time zone, there's no question that the city is predominant, and I would say in a global context, it's between New York and London, and depending on which criteria you take, it's one or the other. But we're therefore, I would say, probably equal with New York as the leading financial center in the world, and therefore critically important.
Michael, thank you. We're going to pick up on that point about New York later. Really interesting stuff from Charles. Thank you about how the ripples of one big boat stuck in the Suez Canal trickles down here and affects us as well, and also much more about Canadian terrorism than I think any of us ever knew. And we'll work on the rebranding of the city as the nation as we progress through the talk, Michael. Thank you. Now, let's just start with something that is on the front pages of the newspaper. Yesterday's Evening Standard it blared, Boris Johnson warns not to leave City of London high and dry in EU financial services deal. This has got to do with the remaining part of the deal that they didn't seal up with the Brexit deal. A memorandum of understanding, if anyone listening doesn't know, is it so imminent they expected it this afternoon even. A memorandum of understanding will deal with regulatory equivalence. There'll be the sharing of tax plans between countries, and also it'll counter financial crimes. Crucially, it affects the ability of banks and financial services to service businesses and consumers across borders. So that's the first thing you have to understand. The second thing is that we've already seen Amsterdam dubbed Europe's top share trading hub, as if we've lost something already. So the question to our panel is, what type of regulatory divergence should we expect? How can this be shaped as a competitive advantage? And is this a big deal that Amsterdam is becoming Europe's top share trading hub? Let's start with Michael.
Well, there was virtually nothing in the agreement on financial services. But basically, the only reference was that there would be a memorandum of understanding coming out in due course. I wouldn't put great weight on that. It I think, will be a very generalized, high-level document simply saying we're going to cooperate. There'll be a regulatory forum bringing together the EU and the UK to ensure that, as far as possible, there are no surprises on regulatory divergence and so on. But I don't think that's going to be a particularly important feature, and I certainly don't think equivalence is going to be part of that. Why was there nothing more in the deal? I think several reasons. First of all, to be cynical, probably not enough votes in it. A view the city can adapt and look after itself. But one has to say that most trade deals don't generally have very much on financial services. If you look at Japanese trade deals, there's nothing really on financial services. Because of the overarching Basel rules and so on, which govern financial services as a global activity. And finally, I'd say that there was probably a danger of the UK becoming a rule taker from Brussels if we tried to force the pace on getting sort of detailed agreements on financial services into the original deal. So I actually think that on balance, it was probably the right thing to park that and come to it at a later stage. And I think the fact there's been basically no disruption to services provided to clients from the city since the 1st of January demonstrates that, and very little disruption to financial services activities, demonstrates that I think the city has been adaptable and flexible and has coped with it. People were talking about a lot of massive job losses. We estimate about 7,500 jobs have moved as a result of Brexit out of London, mostly to Dublin and Luxembourg. But when you consider 2.3 million people employed in financial services, this is de minimis. Now, you talk about Amsterdam share trading. This comes back to the so-called share trading obligation, where the EU requires EU equities to be traded on an EU exchange or an exchange they deem equivalent. This first came to prominence in relation to Switzerland, when the EU blocked Switzerland from trading EU securities in Zurich or Geneva, and Switzerland retaliated in kind. Post-January the 1st, they've applied this to the UK because they have not granted equivalence to London in that context. And share trading in Amsterdam, which was about daily volumes of about 2 billion euros back in December, leapt to an over 9 billion in January, and the UK was reduced commensurately. So there have been some headlines. London loses out to Amsterdam. I think it's worth noting that many of these trades in Amsterdam are actually taking place on UK platforms. So the London Stock Exchange in November set up a share trading platform in Amsterdam, precisely in expectation of this, called Turquoise. And many of these trades are going through the Turquoise platform, and there are 2 other London platforms, so-called Brexit hubs, which have been set up in Amsterdam. So the trading is taking place in Holland, but on exchanges not necessarily owned by the Dutch. So I think that I don't think it's of major importance. The fund management center remains London. The trades are being put on from London, executed in Amsterdam, consistent with the so-called share trading obligation.
Thanks, Michael. Charles.
Well, I'd just like to first of all echo what Michael said there. Realistically, there are not a lot of votes in supporting the city, and I think that is a political reality. But also, it is the point about, I think, while the politicians understand that financial services are very important, they also suspect that we can adapt, and that is what we've done. And I mean, my bottom line on Brexit in financial services, and certainly in the sector I'm sort of familiar with, is it has been a nuisance because we've had to reorganize the way we do our business. But it hasn't changed in any way the business that we have been doing and are going to be doing going forward. It can be summed up like this. I mean, before the Brexit vote, our European clients, and it's a pretty big part of our business, actually, compared with most London-based operations, or European clients generally, were being serviced by UK-regulated brokers and placing their business with UK-regulated insurers in our sector. They're now dealing with European regulated brokers and European regulated insurers. But that is because the brokers and the insurers involved have either adapted their existing European operations or have set them up. I mean, in our case, we already had a very well-established business in France, so that has become the center of our European operations. It's been a chore. It's been particularly difficult for Lloyd's, which is a marketplace, but they've solved that by creating Lloyd's Brussels, and that is bedding in pretty well. It's been operational for 2 years, basically, so it's had time to bed in. You know, we adapt is the message. And if anything, the bottom line is the London market is probably a bit more European than it was before Brexit. You know, it's in a sense brought us slightly closer to our European clients than we were before.
That's really interesting. Thank you both. I understand, and it's interesting to hear your insights as to why the services hasn't been agreed so far. But I must say, I'm really surprised, because when I remember starting to report on Brexit at the beginning of the campaigns, once the the referendum had taken place, everybody talked about the focus on sorting out a financial deal first, and equivalence and passporting, and we all had to learn about what that all meant. And yet it was the last thing, and it still hasn't been done about 1700 days later. But nonetheless, it seems you're both saying that we're still in limbo, and there hasn't been any huge damage yet. But the key thing is this deal. You know, if there's something can be done, but let's turn it around. If something isn't done, would we be better off without any of these restrictions? Would it actually leave us less hampered by not agreeing something, and more free to operate, Charles?
No, I don't think it would. I mean, I don't think you know, we're surrounded by regulations wherever we do business. We have, you know, we just have to cope with that. It is a pity we have a new level of regulation in Europe, but we haven't lost passporting altogether, because our French operation, for example, is passported into the rest of Europe, so it works from that point of view. But I think, you know, the assumption in our corner of the London financial services business was that even if there was a deal, and it did deal with financial services, the net position we'd be in is the same as no deal. There wouldn't be passporting, and I don't think there will be. An equivalence, well, even if equivalence is obtained for insurers, I think they'll carry on using their European operations to write this sort of business, even though a lot of the underwriting is still being done in London. And as far as the insurance brokers are concerned, equivalence is a red herring. There's no doctrine of equivalence in the European IDD, the International, the Insurance Distribution Directive. So it doesn't make any difference to us either. We have to operate through our European regulated entities, and it's as simple as that.
Michael, Charles is making the case there, but when you were talking a bit earlier, it sounded like you were echoing Andrew Bailey's comments. He was also saying that Britain shouldn't, he got quite angry about this. He's saying Britain shouldn't be taking rules from Brussels. He was talking about there being a mistake if the EU was cut off from British banking markets. And he was also, I think, saying that the EU was trying to poach parts of London's derivatives clearing market. The EU have said they're in no rush for a deal. We've got back into this kind of rhetorical battle. Do you agree with Charles wholeheartedly there, or do you think that we could go a different way?
Well, the UK has conceded equivalence. I mean, we're not only equivalent, we're identical. As of today, we're identical. So to say we're not equivalent is stretching it. And the UK has conceded equivalence to the EU because we are identical, and because of a belief that we all benefit from open markets. And, you know, if there's one message I would say is financial markets are global, they're not regional. And to characterize everything as UK versus EU is extremely short-sighted. And the only losers long-term in that will be the EU and UK together, at the expense of, to the benefit of New York, Shanghai, Dubai, wherever it is. So all these markets are global, they're not regional. Just on coming back to the Amsterdam point, there are 10 times as many exchanges in Europe as there are in the United States. It's as if every single state in the US had its own stock exchange. And this is a completely disparate arrangement, which leads to lack of liquidity and expensive outcomes for customers. And it's not in anybody's interest. And I think it's one of the reasons why the equity markets in Europe are relatively underdeveloped compared to the US or the UK, for example. Now, on equivalence, I suppose at the start of this, we had an assumption that we'd have continued access because our regulatory situation is identical. And we expected that mutual access, and that's what we've granted to the EU. So we're not holding up this. This is being held up by the EU. And I think the reason is there's great concern as to where our regulation may end up. Well, actually, two reasons. First of all, I think Paris, Frankfurt, maybe Amsterdam see an opportunity here. It's quite true, as the governor was talking about, to take business from London. That's the first point. It is seen as an opportunity, and one must be open and wise to that. But secondly, a concern that we may diverge, that the UK may loosen its regulatory burden and be more of a threat, therefore, to the continent. People talk about Singapore on Thames in a rather contemptuous way. Anyone who's done business in Singapore and has had experience with the regulator there knows that they're one of the toughest, smartest regulators there are. They definitely have the competitiveness of Singapore as a global financial center in their mandate. So they are extremely interested in building Singapore as a successful global financial center, but they are extremely tough. And we've done business there for many, many years, and they're great people to work with, not because they give anyone an easy ride, they're very tough. So I think that, a sense that there's going to be a race to the bottom and regulation is going to be loosened is quite wrong. But there is concern in Europe that they don't know where the UK is headed. And this is what's holding up equivalence. I mean, it's not, I think, a panacea, because an equivalence ruling can be withdrawn at 30 days' notice. So even if you get it today, if something happens not to the liking of the other party, it can be withdrawn at a month's notice. In essence, the EU has a much more legalistic approach to this. We look at outcomes, and theirs is a much more legalistic approach, which I think is what is delaying some of this. And I know that the Treasury and the bank and the FCA have put in thousands of pages of information, literally, on equivalence across 40 different aspects of financial markets. And we just have to wait and see what happens. I think it's extremely important that we don't retaliate, and that we remember these are global, not regional markets. And we don't do what Switzerland did in terms of banning the trading of Swiss shares in the EU. But it's tough because Europe has said to us, they'll treat us no more nor less than any other country, but the UK is different because of its geographical proximity. So that's the potential is that the US gets better treatment because it's 4,000 miles away than the UK because it's 22 miles away. So we have to live with that, and I think we can. And I hope that sense prevails, and you don't get dislocated markets, which doesn't benefit anybody other than other financial centers in Asia and the United States, and certainly doesn't benefit clients.
Thank you. Well, that's definitely one to watch. The other big thing going on at the moment is, of course, the pandemic. I'm just wondering how COVID has affected both of your markets. Charles?
Well, if you told me this time a year ago that I was going to go to the office once in the last 12 months, which is what I've been, I would have been deeply worried that something was going to happen, which was very bad for us or for very bad for me. But I mean, the answer is I've been surprised and delighted at how well our market has coped. And I would say we've learned a lot. We've learned that we don't need to go up to London every day. We've learned that we don't need to travel around the world so much, but the market has functioned very well under these strange conditions. I think the downside is, you know, a lot of negotiations go in our market face to face. You can do a lot on a Zoom call, but it's not quite the same if you've got a really difficult negotiation as meeting face to face. But the biggest concern I have is in training. Our younger people in the market are not getting the training that they would get by being part of a marketplace and assimilating the knowledge that is the, you know, the key asset that we have in many respects. So, you know, we've coped amazingly well. We've learned a lot about the future. We've learned that we can trade perfectly well on electronic trading, which came to a surprise to some of the older people in the market. But, you know, it's worked fine. And I think that's the same for financial services generally. We've been in a very fortunate position.
Michael, how have you found it?
Well, I mean, it's extraordinary, because if someone had said to you 5 years ago that the world was going to come to a halt, people were going to be locked down for 12 months, and stock markets were going to hit an all-time high, you'd think you were dreaming. So it's been terrible in one sense, and the opposite in another sense. Because of the huge amount of money being thrown at the economy to counteract this by governments, you've had a boom in equity markets, which obviously has benefited people like us very significantly. I mean, it's been, having said, you know, it's been a two-chair market. I think where people have got it wrong is they've looked at the impact on the economy and government debt, and they've thought that is really negative, without realizing the liquidity being pumped into the system, and the benefits of this for some companies, all the ones we know, the Amazons of this world, has been absolutely enormous. So you've had this incredible market performance, absolutely incredible market performance. And it's been a two-chair market until recently, with the tech companies massively profiting and traditional companies less so, although that's reversed recently because you had this extreme stretching of valuation between, say, tech and energy as one example. So it's been good. It's been very good. It's been a very good year for investors. I think that we have people working at home, and the firm has functioned extremely well, which is pretty amazing when you consider that this came out of the blue and you've got 5,000 people working predominantly from home. But I think many people have had that experience. It's functioned well. I do think that when people say it's the death of the sort of city as a center, as a sort of environment for work, I just don't see that. I think that people are going to want to come back and re-engage and swap ideas and work face to face. And if you're managing funds, the proximity of people and ideas and running into people is so important. So I think we will return to a more normalized environment once these lockdowns pass. But I do think flexible working will be a much bigger feature of the future than it has been in the past. The last point I'd say looking forward is I think the risk in markets is inflation. I mean, we've lived through a period of pretty much zero inflation for many, many years. I mean, those of us like Charles and me who went into the city in the 70s, we remember inflation in the high teens. I remember UK government bonds yielding 17% in 1974. And long-term bonds have been yielding in the UK 60 basis points. And you've had negative yields on certain European bonds and Swiss bonds and so on. And it's been remarkable. Why? Because of quantitative easing and the amount of money being thrown at it in bond purchasing programs from central banks and so on. Now, there's been a big reversal in that this year. It's basically in this calendar year, and you've seen long-term bond yields go from 60 bips to 1.5% or whatever it is, and it's because there's a real concern building up about inflation. And I think the Bank of England, put a report the other day, said there's a 30% chance of inflation going almost negative, a 30% of it going to 4% or above, and I guess the balance being somewhere around its current targeting. I think there's a big chance of inflation picking up because you've got this pent-up demand, you've got commodity prices going up. There's going to be, when lockdowns taken off, there's going to be a big demand, and furthermore, it's in the interest, I suppose, of governments in terms of dealing with the massive debt they're building up, that there is inflation to inflate away the value of that. So I think when you look at the risk to markets, that to me, that risk has been completely kept down for many years. I think that's the big risk looking forward.
Thank you. Now, looking wider afield, let me just read you two questions that have come in. One is from James Charrington from BlackRock. He says, what does the UK need to do or not do to ensure the city retains its position as a global financial centre post-Brexit? And this one from Matthew Edwards, wealth manager. I've heard much negativity and a lack of optimism from economists about Brexit. Their reasons are uncertainty. Now we have blown the doors off and are moving in a world of less centralised power. Does the panel feel we can release the power of innovation and regulation to prove the EU wrong? What would be your yes, please moment given our new freedom? Well, we've covered some of that ground. So in answering that, can you also point towards whether we should be looking at Asia, how we deal with Russia? How do we fit in to the world picture? Michael.
Well, I think there are some very encouraging signs in terms of the openness of the Treasury, the Bank of England and the FCA, openness to change. The Treasury is consulting on the UK regulatory framework. I think there are 10 reviews going on right now. One of the most important was the Lord Hill's review on UK listings, because listings in London, IPOs, have reduced quite a bit. They were running at about 15 billion a year up until about 5 years ago. It's now at 4.5 billion. I mean, some of that is just market demand and cyclicality, but I think there is a trend there. And he's come forward with some quite positive recommendations, I think. One of which is that the Chancellor should make an annual report to Parliament on the state of the city, setting out what steps have been taken to promote the attractiveness of the UK as a global financial centre. Now, that is quite a change, I think, in tone. And Rishi Sunak talked recently about Big Bang 2.0 and the city remaining the most, how important it is that it remains one of the most dynamic places in the world for financial services. So, this is new because the FCA in its objectives has never had the competitiveness of the city as one of its objectives. Unlike Singapore, I referenced earlier, but not only Singapore, Tokyo, Australia, many other regulators have the competitiveness of their financial market. The global competitiveness of that market is one of its objectives. That doesn't exist anywhere in the FCA's objectives, which I think is completely wrong. And so when you hear this coming from the Chancellor, when you hear this coming from Lord Hill's review, I think, whatever the question was, the yes, please moment, to me, that is really important. And I think really quite exciting. And the governors said, you referenced it earlier, Mark, we can't be, you said he was getting aggressive or something. I mean, he was quite right. We can't be a rule taker. We can't be a rule taker from Brussels when we no longer sit around their table. It was bad enough when we sat around the table and could be outvoted, but now we're not around the table. We cannot possibly be a rule taker. And I think he made that point very well. And he said the financial system and the stability of that system is global, not regional, which is the point I was making earlier. So the mood music, I think, coming from the bank, the Treasury, is extremely positive. Now, this doesn't mean massive divergence in the short term, because we're identical with the EU, and our starting position, we had a lot to do with the creation of our starting position through our influence in the EU anyway. So there'd be no point in tearing up the rule book for the sake of it. And any change has significant expense associated with it. Any regulatory change, whether it's imposing new rules and restrictions, or indeed whether it's reducing rules and restrictions, there's a cost to that. As Charles will know, there's a big cost to that. So I think one has to be very careful about it. But I do think we are freed now in an intelligent way to plow our own furrow without a race to the bottom or anything like that. And bearing in mind, this is a global, not a regional market.
Charles?
Well, this is unrehearsed actually, but I mean, Michael's hit the nail on the head. The one thing that our sector has asked in response to this Treasury report is this idea that, like Singapore and like Bermuda, which is another big center in our world, there should be a statutory obligation not just to regulate the city, but also to promote the city. And I think Singapore is a very good example, because as Michael has said, anybody who's dealt with it, the regulators in Singapore, have seen both sides of that. Before we set up there, we were courted by the Singapore regulator, but as anybody knows, they are a very strict regulator. So there's no conflict between this idea of a brief to as well promote the market and strict, tough regulation. And there is no doubt in my mind, we're still going to be closely regulated. We ought to be regulated. It is actually part of promoting a market to be sure and have confidence that the participants in it are properly regulated. That's a very important point. If there's another wish list that we have in our corner of the market, as I would have made clear, our clients tend to be A, international, and B, sophisticated buyers. They're not UK consumers and small businesses and that type of thing. And we would like the FCA to make a bigger distinction between the level and the detail of supervision that they need to carry out in our sector for those of us who deal exclusively with large risks and sophisticated clients. The other part of your question was the opportunities. There's bags of opportunity in the world. The center of gravity has moved heavily east. There is a lot of opportunity for certainly our sector, I'm sure other areas of financial services in the Asian market, but it's not limited. It's Europe, it's other things. I mean, we take a very optimistic view of the future and of the role of the city in the global markets which we're talking about.
So I think we've just witnessed the birth of a new charter of competitiveness here, live on supporting wounded veterans. So it was a good moment there. But let's turn it around and let's look at the risks. And I would say for both of your markets, maybe it's China for you, Michael, or please correct me if I'm wrong, but let's start with you, Charles. What about cyber risks, something that you were pointing to a bit earlier? What are the dangers ahead?
I think one of the reasons that London has become, a bit of a centre for the insurance of cyber is because the risks are unknown, and very often the areas we pioneer that aren't established statistics and reliable statistics and that type of thing, and it's a big risk, and it's an area of the market I'm not an expert in by any manner of means, but it's a huge area of interest to many clients of the market, and it's being pioneered. It's still the early days of the development of that market, and I think the people who are involved in it are taking the risk very seriously and seeing, as in so many new businesses, that really the insurance market is also acting as a center of the risk management of this, and as a sort of it's as much about the services as the insurance that concentrate around the market, but it's a big risk.
Michael, what would you say is the biggest risk to your market?
I think the biggest risk is inflation that I talked about.
Sorry, I mean in terms of country-wise. So would it be
country-wise?
Yes.
Well, I think there's also risk in the sense that there's a trend away from globalization, and interests are becoming more nationalist, more inward. And it's a trend that's been going on a while. It's been massively accelerated by COVID. It was to some extent part of Brexit. And I think you're seeing that. And so political risk is quite high, and tension is quite high, whether it's Russia or China and so on. At the same time, China is probably the biggest opportunity. Certainly in our business, it's probably the biggest single opportunity as a source of funds to manage for the government, for insurance companies, for retail investors, and as a destination for global funds to invest in. It's increasingly going into the world index. So index funds are having to up their weighting in China. The markets have performed extremely well. It's pulled back in recent weeks and months, but it's performed extremely well. And it is an enormous market, and it's the biggest opportunity, I think, in the global asset management world. But there is risk associated with it.
We've got a question here. Does New York pose a bigger threat to London's position than the EU? Michael.
Yes. As I said, if the EU turns in and markets fragment, it's New York that will benefit, in my view. And so no question. There is no major global financial center in Europe. And it's going to take a long time to build that capability with everything that goes into years of creating a New York or a London. And therefore, certainly in the short run, New York would benefit if that's the way it goes.
Charles?
Well, there's certainly a very big rival as a financial sector in our area and others. I don't think we feel threatened by them, but we exist in a competitive market, and we have a big share of the global specialty market in London, but we think we can preserve that and possibly increase it. Going back, you're sort of shifting between risks from the competitive point of view to the geopolitical risks. Just replying to that, I think one of the things which has been, there's a big underlying theme going on around the world, which is driving a lot of the political risk in the world, which is inequality. And that has been made far worse in the pandemic, even than it was before. And that is a great source of political instability in the world, and is, in my view, one of the big problems of the future, which is going to cause problems.
Well, you were talking earlier about life during the pandemic. In your own office settings, or in the office settings that you know about, has the clock been turned back a year? We've been talking about diversity, about gender pay gaps, about environmental and social moves that companies are now pursuing very hard. Of course, it's been all hands to the deck this past year, to keep companies going. But then we've seen, as you both touched on, this kind of huge divergence where the stock market has been flying in one direction. And so with all this happening, are people right to be concerned that attention has been taken away? And in fact, progress might have gone back a couple of years on all of these different parameters, whether it's the local inside the office or the general inequality and the feelings of anger and resentment that might build up against the financial services, Charles?
Well, I think it is, you know, the financial services, it's not a sector that has been heavily impacted by COVID. And many sectors of the economy have been very bad. I don't think we've yet seen the full fallout of that. And that is part of the inequality I was talking about. It's why, you know, there are not a lot of votes in Westminster. There's not a lot of people in Westminster who see votes by, you know, supporting the city. It's a reality. Has that been set back? Yes. Has the commitment of the city to the question you raised about diversity, an area where, you know, we know we're behind the game, that has not been diminished in any way in the last year. We're very committed to putting that right in our marketplace, because it hasn't been right and we're not there yet.
Michael?
I haven't seen any evidence that ESG concerns and priorities have taken any step back because of COVID. Quite, I mean, in a sense, the opposite. I mean, we see ESG is now absolutely embedded in virtually everything we do, and it hasn't been put on the back burner because of COVID in any way that I've seen at all. Whether it's what we do as a company or what our clients are looking for when they give us mandates, it's absolutely central to that.
Just to end on, I was reporting this morning on a humanoid robot called Sophia, and she was painting some digital art and it was auctioned off. So you've got an artificial intelligence robot auctioning off art that doesn't actually exist, one of these non-fungible tokens, and someone paid $688,000 for it. So the world is going in a completely different direction. A virtual world is coming up. And I guess the question for you two on this topic is, should we be buying our next electric cars with cryptocurrencies? Michael?
I think that, I mean, it's quite interesting. You've got the governor, the Bank of England saying Bitcoin can go to zero and no sane person should touch it. And you've got Elon Musk putting whatever he did, $1.5 billion of Tesla's corporate cash into Bitcoin. And the short answer is I don't know. I think in a diversified portfolio, a small exposure to a digital currency is not stupid, but you know, who knows? And it's very hard. I can't judge the intrinsic value of that as an investment. So probably if you've got some, buy a Tesla with it. Not a bad idea.
What's the percentage of the portfolio, Michael?
What, of my portfolio?
No. What percentage of everyone listening's portfolio should be in cryptocurrency?
Well, I'm not a great, I mean, I would advocate quite a small exposure. I mean, like 2% for the sake of argument.
2%. All right. And Charles, what do you think about cryptocurrencies? Can they be trusted?
Well, as far as Elon Musk is concerned, I've had one of his products for over 4 years, and I think it's absolutely fantastic. But I wouldn't touch cryptocurrencies with a barge pole, personally. So it's 0%, as far as I'm concerned, would be my recommendation for you.
But can we, Charles, it's not mastermind, I don't want to press you too hard, but a lot of people are talking it up. Facebook are investing, lots of people are backing it. Why are you so skeptical?
Because I don't understand it, and it's as simple as that. As I say, I'm a skeptic because I'm fairly conservative in in my approach to things, but I'm not conservative when it comes to the innovations we've seen. As I say, I've had one of Elon Musk's products for many years, and it's great. Simple as that.
Thank you for your frank answers. I understand there are two more questions, but I can't see them myself.
Mark, if I read out the last question, it says for this, and then we must stop. For the small investor, the uncertainties have been huge. Is the stock market now not for the individual? It sounds as though global uncertainties, the individual therefore is dependent on institutions. Is that, you make sense of that?
Well, shall I try that?
Yes.
I mean, if you take a long-term view, I believe that equities are absolutely the best place to invest. And that's certainly been the truth in the past. And as someone said, with cash, you get poor slowly. And certainly in an inflationary environment, well, in an inflationary environment, you get poor rather more quickly. I find long bonds, even after the backup in yields, not a great place to be given the potential inflationary outlook and the very, very low yields even now. So yes, if you can buy high quality companies that have a strong position with strong cash flows, where you can see an increasing dividend stream into the future, and you're not afraid of volatility, then I think and you're prepared to hold long term, and you don't try and time your entry too precisely, but think long term, then I think it's by far the best investment for retail investors. Whether you think you can pick those companies yourself, or whether you go through a diversified fund with a professional manager, I mean that's a different decision. But as an asset class, it has been for many years the standout asset class, and I think it will continue to be in the future. But you're going to get volatility, and I think one of the things that the regulators don't emphasize enough is if retail investors go into the market, they must be prepared for volatility, because if you hit a bad patch, it's down 20%, don't sell, stay in, put some more money in. And I don't think they emphasize that enough.
I think we should finish now. We're slightly over time. I'd like to thank you so much for giving us such an interesting evening, and for putting some sort of good figures in a way on what we see in the press, these large claims that are put out in the press. So it was very interesting to have your points of view. Thank you both so much. And Mark, thanks so much for being such a great chairman, leading us through that talk. We're going to finish tonight with a 2-minute video from our patron, who is Chief of the Defence Staff, General Sir Nick Carter, and this video lasts, I think, 2 minutes.
Welcome. We've got some tremendous talks over the course of the month of March, which I hope you'll enjoy. I'm the patron of this great charity supporting wounded veterans. The reason I think it's a great charity is I think it provides a very personal, special service to our veterans. Because it's small, it's able to do that in that very personal way. And I also think it's a very imaginative charity. And I hope that in enjoying the talks during the course of March, you'll also think hard about giving generously to our charity, and in particular to our Pioneer Fund, which has been set up for very innovative reasons, hence the name Pioneer. What it's seeking to do is to provide MDMA-assisted psychotherapy to those who are suffering from severe PTSD. This is a very imaginative initiative. It's one that is quite cutting edge. I often say that winning on the battlefield requires courage and innovation. And indeed, defeating PTSD also requires courage and innovation. And that's why I commend this Pioneer Fund to you. And I very much hope that in enjoying the talks, you will give generously. Thank you very much.
Thank you, James. And thanks and good night to all of you. We're going to be doing another series of 3 talks in June on a Tuesday. And then we'll be doing some more in the autumn. So we'll see you then. Good night, everybody.
Thank you, Julie.
Thank you.
Thank you, Mark.
Many thanks, Julie.
Good to see you,
Thank you.
Charles.
Very much.
Bye. Many thanks.